Welcome everyone. Kia ora ana tātou katoa, tēnā koutou katoa. Welcome to the Reserve Bank of New Zealand's Monetary Policy Statement for August. As you will be aware, the Monetary Policy Committee has agreed to retain the current stimulatory level of monetary conditions, keeping the official cash rate at 0.25% for now. Today's decision was made in the context of the government's imposition of level 4 COVID restrictions on activity throughout New Zealand. Just to be clear, we operated with the same publicly available information and made our final decision this morning. The committee will assess the inflation and employment outlook on an ongoing basis with a view to continue to reduce the level of monetary stimulus over time so as to best meet our inflation and employment policy remit. This action follows the recent halting of additional government bond purchases under the large-scale asset purchase program earlier in July. Global monetary and fiscal settings do remain at accommodative levels, and that has been supporting international spending and investment. Rising vaccination rates across many countries have provided this economic impetus. The rise in activity has continued to support demand and prices for New Zealand's goods and services, in particular our export commodities. However, the need to reinstate COVID-19 containment measures in many regions highlights the serious ongoing health and economic risks posed by the COVID-19 virus. Persistent and elevated health risks are promoting an ongoing global supply chain disruptions and are acting to constrain productive capacity in many economies, and this promotes inflationary pressures. Today's reintroduction of level 4 restrictions to activity across New Zealand is another stark example of how unpredictable and how disruptive this virus can be to economic activity. The committee noted that the New Zealand economy had rebounded more strongly than most countries, with less disruption caused by the COVID-19 to date. So the New Zealand economy is in a very strong position. Employment is currently at or above its maximum sustainable level, and consumer price inflation expectations remain well anchored near the midpoint of our target range, around 2%. Recent data for the New Zealand economy suggests demand remains robust and the economic recovery has broadened. This is despite some weaknesses still persisting in sectors most exposed to international tourism. Household spending and construction activity are especially strong and continue to grow, and business investment is responding to this increased demand and supply pressures. Capacity pressures are evident in the economy, particularly in the labour market, where job vacancies remain high, despite unemployment remaining high, or unemployment remaining around 4%. So we're seeing a position where there are vacancies and ongoing unemployment. We have seen unemployment decline and we've seen underemployment decline. So these capacity constraints are there. Wages are rising, consistent with the tight labour market conditions. Broader inflation pressures are being accentuated in the near term by one-off price rises such as high oil prices and temporary factors such as supply shortfalls and higher transport costs. Near-term consumer price inflation is expected to rise above our target range before returning towards the midpoint by the middle of next year, around 2%. The committee agreed they are confident of meeting their inflation and employment remit with less need for the existing level of monetary stimulus. However, the committee remains alert to the supply disruptions that COVID-19 can create and the dampening effect this can have on business and consumer confidence. House prices are also above their sustainable level, heightening the risk of a price correction as house supply increases. The committee agreed that their least regrets policy stance is to further reduce the level of monetary stimulus so as to anchor inflation expectations and continue to contribute to maximum sustainable employment. They agreed, however, this morning to keep the OCR unchanged at this meeting, given the heightened uncertainty with the country in a lockdown. Me taki mai tā. I am open to questions. I want to note that I am joined online with our Chief Economist and Yung Ha and Assistant Governor Christian Hawkesby. Thank you.
Cool. We have our first question from Katie Bradford to One News.
Good afternoon. Adrian, how worried are you that this lockdown, if it's prolonged, will lead to further unemployment and business closures and those sorts of issues if this was to carry on for some time?
I would say in an absolute sense, it's always a concern. In a relative sense, we are far less concerned than I would have been standing here this time last year. What we've learnt is a lot. We've learnt the importance of the vaccinations, the health response, and especially the government's fiscal response. The wage subsidies and business payments have been incredibly powerful means by which incomes have been retained and engagement with the labour market has been retained. So we see the country being in a very good position to maintain economic momentum through for a long period of ongoing disruptions. Likewise, we are at a position where capacity constraints exist. We have maximum sustainable employment. We have a very stable financial system. We are in good stead to continue to grow and prosper, even though we have to manage these difficult health situations.
Next question, Tom Polistrica from Stuff.
Yeah, hi. Just a couple of questions. Just for clarity, it's correct, is it, that the Reserve Bank would have increased the rate by 25 basis points were it not for this community outbreak? And just the second question, I just wanted to what extent have you sort of built in assumptions, if at all, around the community outbreak into the OCR forecasts that you've updated today? What sort of expectations are they reflecting?
Yeah, great questions. Thank you, Tom. So first up, the decision is always final on the morning of our announcements. The recency is important, and so there was no final decision. We made it this morning in light of all of the information. Having said that, as you can see by the document, our clear direction is to be reducing monetary stimulus, that is lifting the official cash rate, and that in turn tightening monetary policy. So this, in a sense, has not shifted us at all from that broad path, but it has given us time for pause while we observe, like everyone else does, the outcomes of the next few days and weeks. Looking forward, though, we have seen the demand capability to hold up. We've seen the flexibility of business. We've seen the ongoing consumer spending power of households. So we are comfortable on the demand side. Our concern is around supply capacity at the moment. So for our medium term, we remain on course to be managing that, a tightening in monetary conditions. What assumptions do we have in here for this COVID situation? The answer is we have built in permanent flexibility. We don't believe there's going to be a binary situation where we have the issue, we no longer have the issue. Instead, we're going to have rolling periods of disruption as we see around the world, and we have to be able to manage those periods of disruption. And so, that was written about in the document. No one anticipated it being a live example on the day of this announcement.
Next question from Junaid Tibshanaid, Interest.
Hi there. Governor, how confident is the Reserve Bank that maintaining such loose conditions will continue to be effective? Or put another way, are these loose conditions less effective now than they were, say, a year ago?
Thank you, Junaid. I would use the phrase less necessary rather than less effective. less necessary in the sense that, as explained in the document, we're seeing the strong growth, maximum sustainable employment, inflation expectations near the midpoint, actual inflation likely to rise above. All of this suggests there is less need to continue the monetary stimulus that we've had, subject to the economy evolving. And that is our intentions. We started a path to less stimulatory conditions in July by halting our large-scale asset purchase program, and that is our plan going forward. Very clearly in the document, we would have to see significant different outcomes, in particular to demand, to change our mind.
Our next question, Jenny Ruth, Business Desk.
Hi. Wouldn't it make more sense to remove the unusual measures that you've taken, such as the FLP, and start selling back all those bonds that you've bought? Wouldn't that make more sense before raising the OCR, seeing they're only there because of the COVID crisis?
The official cash rate is our preferred tool. It is, we have much clearer direction between actions and outcomes. And we are also, of course, would be far preferred to be using an interest rate tool that is well understood by the markets, by the public, I should say. And on top of that, we have stopped purchasing further, using instruments in the market. In the document, we talk about providing guidelines on what we will do with those instruments through time based on exactly the principles we used when we implemented them. So we feel in a very comfortable, confident position with the official cash rate.
Next question, Bernard Hickey, Kaka Media. Sorry, Bernard, let's get you started again.
Bernard, you're on mute.
Thank you very much. Governor, thank you very much for the monetary policy statement in box A, which talks about house prices being above their sustainable level, and the Reserve Bank's forecasts seem to suggest its central forecast is for a 15% fall in house prices. Could you talk about where you see the sustainable level at and how far above sustainable house prices are at the moment?
Yes, thank you, Bernard. And also thank you for calling out what I think is an incredibly rich document for those who are at home, and I can see many who are asking me questions are. I do encourage you all to enjoy, imbibe, read this fine document. And what we're talking about here is one of several special features in the document. We talk about the level of house prices currently compared to what we think would be a more sustainable level. By sustainable, we're talking about what we can explain where house prices would be given demand, population, and people per houses, and supply, the number of houses that are available. And we are very adamant in here that current house prices are above what we would call that sustainable level. I can't go as far as to say exactly how much, because sadly, I give you the glib answer, that depends, but I can give you plenty of indicators of why we think they are above sustainable. The first one, of course, is the increase in housing supply that is coming onto the market effectively from end of this year onwards. I think we're seeing the largest increase in housing supply since the early 1960s, and that is coming at a time when New Zealand's population growth is at one of its lowest growth rates. So supply is going to outstrip marginal demand, and that would naturally have a downward impact on house prices. Current house prices should be reflecting the current pressure. More supply means further downward pressure on those on that house price. The other types of measures that we look at are really around long-term debt to income ratios. Housing debt, mortgage debt relative to household income is at very stretched levels. And that means that any small increase in interest rates has a magnified impact on debt servicing, and debt servicing across households is also at a stretched level. So it means the new buyer, the marginal investor in a house, is taking on significant level of debt at interest rates that may be going up. And so again, not only just demand and supply, but the price of debt and the debt servicing component means downward pressure on house prices, less ability to leverage into homes. And as you're aware, there has been many other policies on housing of recent, which all have a dampening effect on house prices. The tax changes discussed by government and our loan to value ratios, as well as the ones that we are consulting on, and debt servicing ratios. So from our view, the current house prices are above sustainable levels.
You mentioned in the document a median house price to income scenarios, which suggest a fall towards these 8 to 9 levels seen in 2020. Where do you think is a sustainable level for the house price to income ratio in the long run?
Can I just encourage people, these are good questions, Bernard. I would encourage people to read and observe the document so they're aware. And I'm going to say, you know, the first thing is I can talk around sustainable house prices. I can look at actual house prices and we can talk about corrections. What I can't do is tell you when or by how much, because these are asset prices, they're highly volatile, and they are captured by the spirit of people buying these assets. So I'm talking around the blank, unemotional economic events. What we see through time is house prices can fall, do fall, usually in real terms, i.e. once adjusted for inflation, but when we're at low inflation, they can fall in nominal terms. And we have a projection there where house prices, previously we had them finishing at 0, we've now got them going slightly negative. I think it's around a -5%. Can I ask Jung to correct me, Jung, if I have my projection wrong?
That's right. The house price inflation number troughs at about -5.
Okay, next question. Praveen Reuters, did you have a question? Matt, we'll go to you next. So you're on mute, Praveen.
Mute.
I will try Matt. Try to Matt from Kanga News. We'll come back to you, Praveen. Matt, your question.
Yeah, thanks, Oliver, and thanks, Adrian and the RBNZ team. Matt Zonmeyer here from Kanga News. I wanted to ask about your observations of the New Zealand government bond market since the end of the LSAP in late July. Obviously, bond yields had widened significantly in New Zealand over the last few weeks up until yesterday. So, just keen to get your assessment of bond market functionality in the wake of the end of the LSAP program.
Great. Christian, you care to comment?
Yeah, thanks. So market functioning has been a key factor that we've been considering when we look at the rate of large-scale asset purchases on a week-by-week basis. As we've progressed through this year, we were getting very clear message from the market that smaller purchases from us would be conducive of better market functioning through to us, discontinuing or halting those purchases. What we've seen since we've stopped our weekly purchases is market functioning has continued well. We've been encouraged by the way that market has developed since then. Yields have moved around with global yields, but still remain relatively low on an overall basis.
Another question from Jenny Ruth, Business Desk, and then we'll go to Tom.
Is the intention to start buying back all those bonds that have been purchased at some point?
We will announce the principles and our intentions in coming months.
So is that a yes
So I
or?
think
You're not going, surely not going to just keep owning them.
As I said, we'll announce in coming months. Christian, can you elaborate on that?
Yeah, so that's right. We've halted purchases on a weekly basis, but we're conscious that we need to communicate to the market what our intention is with our balance sheet and with those schemes. The main practical decision ahead of us is the maturity of the 2023 bond and whether we reinvest some of our current assets into once those mature. So that gives us plenty of time to outline a plan ahead of that, and that's what we've indicated in the document today.
So you're not likely to start selling them back before then?
We will outline our plan in the period ahead. Globally, we haven't seen any central banks actively sell their assets back into the market. They've typically not reinvested maturing assets. For us, we need to go back to first principles and really base it around what are we trying to achieve with the stance of monetary policy that the Monetary Policy Committee wants, and how can we do that in a way that's supportive of market functioning, which we've already talked about.
Right, next question, Tom Polistrick, and then we'll go to Matt, and then back to you, Bernard. Tom?
Yeah, thanks. Just a hypothetical question, I'm afraid. I saw that it noted that the Monetary Policy Committee believed a response might be monetary response might be needed if the lockdown had a more enduring impact on inflation and employment than expected. What is the sort of next tool off the block if that in that situation is it more likely to be a sort of OCR reductions or return of LSAP or a blend, or do you have any thinking on that?
Yeah, so we're in a much stronger position now, Tom, as you realise. So banks are able and capable of shifting the OCR and or managing OCR changes, I should say, in many directions. And our preferred tool, first and foremost, is the official cash rate, but also going back and reminding people ancient history around, we will be choosing and selecting the instrument we think is most effective and efficient and able to be managed on the balance sheet, subject to what we're trying to achieve at the time. So I'll answer your hypothetical with a conditional that side. I think Praveen, I don't know if he found his button, sorry. Nope.
No, maybe try to type the question and Praveen will come back to you. Matthew Brockett, Bloomberg. Oh, Matthew, you're on mute.
Mute.
I'll try and come back to you. Bernard, we'll go back to you. Seem to have issues with.
Thank you. I don't think I'm on mute, which I'm thrilled with. Governor, could you talk about how much of a preference you have now for the OCR relative to the LSAP, given that you now have the funding for lending program in place to deal with negative interest rates, and the banks have rejigged their systems to cope with negative interest rates, i.e. if you needed to ease again in the event of a very long, painful lockdown, would you prefer to use negative interest rates over LSAP?
I can't answer that or the outright again. It's a function of the conditionality. I'm pleased you have reminded people that banks are capable of having the negative interest rate. So again, that's a hypothetical answer with a conditional. it's incredibly hypothetical. What we're talking about in our document is the country being able to manage periods of disruption created by these virus outbreaks. We are in a much better position to manage it via fiscal policy. We understand what those policies are and how they can be used effectively. Monetary policy will be there to support. Our biggest concerns at present are not about lowering the OCR, it is about making sure inflation expectations are well anchored. So I don't want this conference to get confused. I want this conference to understand that our general path is to be tightening monetary conditions, not to be worrying about negative interest rates.
And just a related question, is the Reserve Bank concerned, or is it a factor that New Zealand seems to be quite a bit ahead of the rest of the world's developed countries' central banks who have yet to signal the sort of hikes that you're talking about?
It's just a base fact that we run monetary policy for Aotearoa New Zealand, not for these other countries. New Zealand has been less impacted to date from the COVID-19. That means our economy has been stronger. We've come up against capacity pressures sooner, and hence monetary conditions may need to move sooner. And so it's a very strong and positive position to be in. And that's well recognised. We've done a lot of search across countries to assess for differences, and most of the differences come down to starting point and strength than anything else. Likewise, it goes for asset prices and house prices. We've seen asset prices rise globally, again, in part due to the low interest rates, but the magnitude and timing of that has really been as much related to supply constraints, differences across countries. So similar experiences, probably T plus 6 months ahead of some countries. There is a queue of countries talking about what we are talking about today. So we aren't actually on our own, and most of those are small open economies like New Zealand.
I do have a question here. Yeah, I think Praveen has asked, RBNZ is still projecting a hike this year. What would you do if that lockdown is still on?
Well, we have to keep thinking about our medium-term inflation and employment forecasts. So the lockdown still being on, it's going to be a function of what is happening to demand and demand spending, and what is happening to the supply capacity of the economy, because that is what's going to determine inflation and employment. And so, we aren't going to be, we have to operate, we have to continue moving even in a world of uncertainty, and the Monetary Policy Committee is comfortable doing that as signalled.
Janae's got one more question. Janae, interest?
Thank you. Did all members of the Monetary Policy Committee agree to keep the OCR on hold?
It was a very strong consensus today, I would say, through the course of the week. It has been a very consensus-driven action. We've talked about having increased confidence around where we're at, having increased courage to do what needs to be done, and of course, as we said before, the patience to do it when it is right. And so we are in a wonderful position of optionality now, where we have maximum sustainable employment, inflation anchored, and we are able to talk about renormalising monetary policy. The challenges around renormalising monetary policy is one, the uncertainty that we're sitting amongst today, but two, getting people to remember as far back as 2 years ago that neutral interest rates are, a neutral OCR is 2%. It's not 0.25%, and to think about their spending and investment on the basis of on average, not just what they see today. And that is the strong signal we put through many parts of our document, in particular with regard to house prices and mortgage debt.
Just to follow up, did any members of the committee disagree?
I don't go into that. We don't, if we have to go to a vote, we would go to a vote. We didn't have to go to a vote. Wonderful.
Any last final? I think that's it.
Okay, well, I just want to again thank the Reserve Bank team. I want the people of New Zealand to know that their central bank, Te Pūtea Mātua, is open, operating as usual. The financial system is in a very strong and robust position. The banks are well capitalised. They are your long-term friends. Talk with the banks through difficult times. And thank you to the economics team. Please do read and absorb. Read firsthand. Who knows what you'll learn. Me taki māta.